AJ Russell from mining.com.au, and I'm coming to you from the Rules Symposium in Boca Raton with Mr. Rick Rule sitting next to me. Rick, do I even need to introduce you anymore?
Well, if you do, be flattering. I think it's easy enough to say that I'm your host at this conference.
You are my host at this conference. Thank you so much for having me. It's been an incredible time. Also, the great weather that you've put on for me. I don't mind getting out of cold Melbourne. But I want to kick off today's chat with something that I've picked up from this conference. So every year at your conferences, I sort of notice that there's a common thread. Last year, the common thread appeared to be everybody was asking what company was a takeover target. Investors seem to very much have that mindset. This conference, I've noticed there's been a lot of references to the Lassonde curve. Tell me, are we making the Lassonde curve fashionable again, or are we trying to educate investors on how the market moves? Because the market sucks for some mining companies right now.
There wasn't any deliberate focus this year on the Lassonde curve. There was a deliberate focus last year on amalgamation because we thought it would occur, and we were right. I believe that amalgamation is an ongoing theme. With regards to the Lassonde curve, one of the things that was demonstrated to us well over the course of the year was that the last part of the Lassonde curve, which is to say the development process, has become a very investable theme. Lobo Tigre has demonstrated statistically that the period of time between shovel ready, which is to say permitted and financed when construction starts, and first pour, generally takes about 24 months, 24 to 30 months, and almost invariably results in a double. That is something that I guess I understood a bit from experience, but I didn't understand the statistical significance of that. And that's become very important. So investors or speculators in the smaller cap space and the developers have come to learn that there's a predictability around construction, which is to say you sit out the boring part of the Lassonde curve and you take advantage of what has at least recently statistically been the sweet spot of the curve.
One thing I have noticed with the curve that was being introduced today with contango ore is that they stretched out the time frames. That it used to be, when it was first theorised, it was 2 to 3 years from sort of discovery to construction. And contango ore, suggested that it was now more 5 to 13 years, and that not all explorers or early stage developers can survive that period. Do you hold a similar view?
I think that depends on jurisdiction. One of the uncontrollable parts of the Lassonde curve that doesn't necessarily relate to the quality of the ore body is permitting time. A good ore body really truly finances itself. A high quality deposit will find a way to get the money. High quality deposit may or may not find a way to get permitted. There's a very high quality copper deposit in the United States called Resolution, controlled by the way by a couple of at least quasi-Australian companies, Rio and BHP. That deposit was discovered in excess of 30 years ago. It's been in the permitting process for 26 years.
Gee whiz. That's not the word I want to use, just so you know, for everybody listening.
Yeah, I understand. I don't think it's the word that either BHP or Rio would choose if they had the ability to.
That is an insane amount of time. Okay, so look, obviously all companies are operating in different mining jurisdictions. Permitting is a serious problem.
It is.
Who is, I think, with your wide lens on this, who do you think is, what countries I should say? I'm still a little rusty from all those drinks last night, I'm just going to let everybody know. What's the most favourable permitting jurisdiction at the moment for you?
In terms of first world jurisdictions, probably still WA.
WA.
It's getting worse. But the truth is that the constituency in Western Australia, which is to say the citizenry, are relative to other jurisdictions relatively knowledgeable about mining. It's been an important part of not just the history but the current reality of Western Australia. Unfortunately, Western Australians are allowed to vote, and sometimes the people that they elect exhibit less knowledge than the people who elected them. So while for most of my career, 40 years, WA has been a really favorable jurisdiction for me, partially because of geology. I mean, the geology's spectacular.
Highly prospective.
A lot because of the embedded human resources in Western Australia. I mean, very, very, very knowledgeable geologists, engineers, miners, all that kind of stuff, but also partly because the jurisdiction has been rules-based and sanity-based for 40 years. That sadly is beginning to go away, but it still compares well with other jurisdictions because it hasn't deteriorated as fast. Traditionally, my favorite jurisdiction in the world was Chile. Chile has gotten much worse, much more quickly. It was in Chile, as an example, in environmental regulations in Chile, they were sensible, but they were not voluminous, and they were enforced. And you basically had a contract with the Chilean government that said that, you know, emissions would be this, there'd be no export of deleterious material, blah, 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 blah. And if you failed, it was a criminal, not a civil offense. So the permitting times were short, the guidelines were fairly strict, and by the way, they didn't, if you failed, prosecute you civilly, but rather criminally.
So that you're incentivized to get it going.
The penalty for failure was high. That's been replaced by a much more amorphous regulatory regime, which is too bad.
I want to throw a question back at you that I heard from your stage. There was an exploration panel yesterday, and there were quite diverse opinions on there. There were two of my favourites up on stage, Brent Cook and Joe Mazumdar. And the host asked the question, has anybody on the panel recommended or invested in a single asset company prior to discovery? Now, there were a diverse number of opinions. Lobo, I can't pronounce his name, I'm sorry, his surname, I'm terrible at Spanish, said absolutely not. Brent and Joe were quite optimistic and have said, yeah, we would. Would you consider doing something like that, or have you in your vast experience?
Absolutely.
And did it work out?
Yes and no. I'm attracted to geology. I have the good fortune at 71 years of age to know an awful lot of good geologists. And so it's relatively easy for me to access knowledge of others in terms of the prospectivity of exploration terrain. I prefer, if I'm going to engage in grassroots exploration, to do it through prospect generators, for people who generate the project and they use other people's money to explore it. But I violate my own rules on numerous occasions, and having access in particular, when he worked for me, to the expertise of Brent Cook, to look at these single asset early stage exploration companies, I've done quite well from time to time. You need to understand, Shay, the arithmetic of exploration speculation, which is to say that most of the decisions that you make will turn out to be wrong. That's the way it works. You lose 25% on this one, 30% on that one, 32% on the next one. Occasionally you're successful and you make 1,000% or 1,200%. A 10-bagger, 1,000% gain, amortizes a whole bunch of 25% losers.
It does.
You have to have both the financial and the psychological staying power to be in that game. For me, having 45 years of experience in high-risk speculation, I understand that losses are a constituent of success, that you have to endure several failures to enjoy a success. And I'm easily willing to do that, psychologically capable of it, and now financially capable. I did it before I was financially capable, and I got lucky.
Tell me, do you have a biggest loser to date that you're willing to discuss publicly?
Do I have?
A biggest loser?
Oh, my biggest loser. Boy, what would that be?
I've made plenty of investing mistakes.
Well, my biggest loser was something called Heating Oil Partners, which was a heating oil distributor. And I bet that they would be able to refinance their debt, although they had too much debt and carry on. What it turned out was that the management team, I guess, didn't own much stock, allowed it to go into bankruptcy, and salaried it through the bankruptcy process. So I would say that my big mistake was not understanding the alignment of management incentives. That was a 100% loss.
Oh, yeah.
I've had other 100% losses too that were easier to explain. As an example, early on in the U.S. adventure in Afghanistan, I had occasion to run into a geologist who had been part of the Afghan Geological Survey before the Taliban. Learned a lot about Afghan geology and learned that the Afghan Geological Survey, rather than being destroyed by the Taliban, had gone home with the employees. And so I and several of the rest of us invested in something called Afghan American Mining, and we lost 100% of our capital because the politics in Afghanistan didn't improve as rapidly as we had hoped. But that's unexplainable. You know, we knew going in that there was a chance of that.
Yes.
The size of the prize was so enormous that if I had it to do all over again, I would take exactly the same chance today.
Look, it's definitely a risk worth taking in that case because, as you said, you can't repeat that kind of success anywhere else. So I completely understand that one. Now the clock is ticking on our time together, and I've been very fortunate to be here. One thing I always try to take away from your conferences are sort of key investing lessons. What would be your key investing lesson for your average retail investor from this resource conference this year? Work.
Work.
I bet you that's not the answer everybody wanted.
No, most investors follow the precept, got a hunch, bet a bunch, which doesn't work. I ask speculators to have the number of stocks in their portfolio that corresponds with the number of hours per month they're prepared to work, understanding their companies, reading the quarterly reports, reading the proxies, reading the management information circulars, and trying to understand them. So the first thing that I would do is work. The second thing is, and I've known a lot of speculators in my life. For many speculators, they invest in long-term themes with short-term strategies. If you believe that the copper price is going to go up over 5 years, and you expect to be rewarded in 3 months, there is a disconnect between your expectation and your strategy. And I've watched that happen to literally thousands of investors in my life. If you do the work, you have patience because you understand what you've invested in. If you've got a hunch and you bet a bunch and it's down, if there's no correlation in your mind between the price and the value, you don't have the patience to stay the trade.
That is an incredible way of looking at it, and even though you said you've got to do work, I think there's some really sound information in there. Rick, I know you've got places to be and people to see. I'm very grateful for our time together. Once again, thanks for bringing me to Boca Raton.
Well, Shay, thank you for coming. Thank you for coming across the pond. I understand you had an arduous journey getting here.
119 hours. I was traveling longer than I've actually been here.
Yeah, I mean, probably the next time you should go the other way, you know.
I'm taking a boat. In 2025, I'm getting on a boat. I'm going via Hawaii. I'm not doing that again. And again, not using the words I want to use.
I understand. Well, I thank you for your efforts getting here. I thank you for your efforts being here. And I look forward to seeing you again somewhere, sometime.
Thanks, Rick. This has been great.